Two opposing truths exist at the same time. Some of the largest financial institutions in the world publicly state that Bitcoin has no intrinsic value. At the same time, those same institutions, or their direct competitors, are facilitating, distributing, and profiting from Bitcoin exposure at a global scale. This is not confusion. This is structure. Today, we break down the Bitcoin institutional debate using facts only, and explain why understanding this contradiction is critical for top profit investors. The statement, "Bitcoin has no intrinsic value," did not come from retail investors. It came from senior executives inside traditional asset management firms. This position is grounded in classical finance theory. Bitcoin does not generate cash flow. It does not produce dividends. It is not a claim on earnings. By traditional valuation models, Bitcoin cannot be priced the same way as equities or bonds. These facts are correct, and publicly documented. Now comes the contradiction, based on observable data. Regulated spot Bitcoin exchange-traded products have been approved in major markets. These products are issued and distributed by some of the largest financial institutions on Earth. Pension funds, asset managers, and family offices are accessing Bitcoin exposure through regulated vehicles. Major banks provide custody, clearing, and risk infrastructure for digital assets. These actions are not ideological. They are operational. Institutions do not deploy capital, legal resources, and reputational risk into assets they consider irrelevant. Both statements can be true at the same time. Bitcoin does not fit traditional valuation models. Yet Bitcoin fulfills a different institutional function. It operates as a scarce digital asset with a fixed supply, a globally transferable settlement layer, a hedge against monetary expansion risk. Institutions are not buying a belief. They are offering access. They collect fees. They control rails. They monetize volatility. This is not adoption driven by conviction. This is adoption driven by demand. The real risk is not whether Bitcoin has intrinsic value. The real risk is misunderstanding who controls access. As Bitcoin becomes financialized, access shifts to regulated channels. Volatility becomes monetized by institutions. Retail behavior becomes predictable liquidity. History shows this pattern repeatedly. When institutions build infrastructure, profit concentrates upstream. Those who understand the structure early operate from strength. Those who do not become the exit liquidity. The Bitcoin debate is not about belief. It is about structure, incentives, and control. Institutions say Bitcoin has no intrinsic value, and still build systems around it. That contradiction is not weakness. It is strategy. Top profit investors do not follow narratives. We follow capital behavior. And capital has already made its move.